Lately, some of you guys have not been part of some amazing trades. Stop missing out, okay? I'm gonna show you some techniques today that'll blow your mind. Why is this important? Why is this relevant right now? I'll explain right away. Now, I only have time to spotlight a few trades today. Next, click the link below to take my free class that shows you the secret to massive profits with ETFs and options. Once you know the 5 market cycles of boom and bust, you can predict precisely what major stock sectors are set to do over the next 2-week period. I'll walk you through it all, step by step. Sign up now for my class. The S&P 500, okay, is divided into 10 major sectors, okay? Those 500 stocks that you see, the S&P 500 stocks, if you take all of it apart, you will see that they're divided into technology, real estate, industrial, material, finance, utilities, consumer staples, consumer discretionary, energy, and health, okay? Those are the 10 major sectors. There's been an 11th one added. It's called telecommunication, but honestly, it's just tech. So I leave it back to the original 10 sectors. Now imagine for a second, okay, if you can take only the sectors that are rising and avoid the sectors that are falling, or better yet, instead of avoiding sectors that are falling, what if you can short the sectors that are falling, right? That's called having your cake and eating it too. So imagine you have a race car. Imagine you have a race car that has 2,000 horsepower, all right? And it's ready to go. And imagine you have an elephant holding it back. How far or how fast do you think that race car is going to go? It's not. It's going to stay still. It's not going to be pretty, okay? We don't want that. So what we want to do is this. We want to isolate only the strongest sectors, okay? And we want to eliminate the weakest ones. If we can do that, if we can take these 500 stocks and only choose the best ones, or choose the sectors that are the best ones, we can really see some major gains, okay? And here's the thing, the markets have a cycle. There are cycles, and these cycles dictate which type of stocks rise and which ones fall. For example, right now, the Fed made a statement, interest rates are not gonna go higher for the next 9 months. That means financial stocks, for example, are probably not going to rise too much because we already know interest rates are going to be low and financial stocks make their money on real estate. Another example, okay? Real estate. All right? Similar scenario than finance, except if interest rates are low, that means real estate stocks are probably going to rally. And again, these two examples that I'm giving you right now are just very, very basic. They're not extensive. They're just basic, just to give you an idea of what I'm talking about. And this applies to all 10 major sectors, what I'm talking about right now. So the key is to find the right sector and to avoid or short the right sector. So let me show you what we've been up to. 2 weeks ago, we had a cluster, a position cluster. And a position cluster is where we combine only the top sectors. We don't know if we take 3 sectors or 2 sectors, we don't know which one's going to be the big winner or loser, okay? We're using statistics for this. We're not going to put all our money into one thing. That's just being foolish, and we don't want to do that, okay? So what we're doing is this. We're taking the 3 sectors that are supposed to rise the most, okay? And that's these 3 sectors here. And we're shorting the energy sector because our analysis told us that energies were going to go down and these 3 sectors were the best sectors over the last 2 weeks. And again, this is just a little taster for you. I'm going to get into a training session and I'm going to explain to you everything. This is just a tease. I'm just trying to get you guys to understand the basic concepts of how you can overcome that 500 stock impediment to gains that the S&P holds, okay? And again, just use the example I gave you. Look at a sports car and think that there's an elephant behind it. It's not going to go very far. So we want to eliminate that elephant, all right? Or we want to put that elephant in front of the car so it helps push the car quicker. We don't want it holding us back. So let me show you this, how all this washed out. We held the positions for 2 weeks, 10 trading sessions. We created a portfolio, and the portfolio, let me go back real quick. And the portfolio had 25% long tech, 25% long industrial, 25% long real estate. And we don't have to pick 20 or 30 or 40 or 50 stocks out of the 500 to do that. We just pick 3 sectors. These 3 sectors have all the stocks. So we're not trading 50 or 100 positions. We're just holding 3 long. And to give us a hedge, our system, our rotation cycle told us that energy sector was going to not perform too well. So we shorted the energies and we went long these 3. And keep in mind, if the stock market was bearish, if the stock market was coming off, well, we may reverse this. We may go short tech. We may go short industrial. We may go short real estate and long energy. So again, every 2 weeks, we reevaluate our entire cluster. We pick the strongest and the weakest, and we create a position cluster. Now let's go back. So we did this with options, and you can do this with options or you could do this with ETFs. Obviously, options have bigger leverage, so it'll give you a lot more profit potential. But you can do this with stocks or options. But watch this. We gained 19% in 10 trading sessions. We purchased the cluster for $95.83. All right. And again, you don't have to spend almost $10,000 on this. You can spend $1,000, $2,000, $1,500, even $500. These are options. They're not expensive. And we closed the position out for $11,401, just 14 days or 10 sessions. So we were able to pocket a 19% return by trading position clusters in 2 weeks. The S&P 500 over the last 20 years averages 5.98%. Let me show you this. 5.82% over 20 years. We were able to get 19% gain in 10 trading sessions, all with limited risk, by identifying position clusters, by understanding how the market rhythm works, and by using statistics. And it's really simple, it's not complicated, and I'm gonna do a workshop for you, and it's gonna explain everything you need to know about it right now. I'll talk to you soon. That's a wrap on today's lesson. Click the link below to learn more about my free options and ETFs class, where you'll find out the sector roadmap that holds the key to 2,289.56% returns in less than 8 years, all with non-leveraged ETFs. Don't skip this free training, grab your spot today.